think we'll just give people a couple more minutes and then we can kick off maybe at 12:32. All right, why don't we kick it all off? So thanks everyone for joining today's webinar. My name's Alex, I'm the co-founder of Sprint Law, and I'm joined by Scott Weddle, who's the head of commercial operations at Swoop. And today we're going to be talking about a very fun and exciting topic, funding and legal checklist for growing your business. So the housekeeping for today, we're going to go for about 45 minutes, and we're going to have some time for at the end for a little bit of a Q&A session. But if you do have questions that kind of come up during the course of the presentation, do feel free to drop them in the chat box, and we'll keep an eye on them and either ask them as we're going or just try and make some time for them at the end. Yeah, we're going to be recording this webinar, so there'll be a copy of it that'll be sent to all of you if you want to revisit anything that we discuss a little bit later. So the agenda will be, we'll give you a little bit of an introduction as to who we are and sort of what our businesses do. Scott's going to then talk a little bit about Swoop, what the Swoop business does, and we're going to divide the conversation into two parts. We're going to kind of do a bit of a mutual Q&A. So in part one, I'll be asking Scott some questions about fundraising for business growth, and talking a lot about sort of different types of funding available and how all that works. And then part two, we'll flip it around and Scott will be chatting to me about the legal side of things and the sort of legal considerations to be thinking about as your business enters fundraising. And then we'll have the Q&A at the end and sort of close it all up. So just to give a really quick intro as to who I am, as I mentioned, the co-founder of Sprint Law. We're an online law firm made for startups and small businesses. I'll talk a little bit more about what we do later, but my personal story, I started my career as a corporate lawyer, working at one of the sort of large law firms, but also had a little bit of a background in technology before that, having run a couple of technology businesses, and founded Sprint Law about 5 years ago, really as a way of combining the opportunity to use technology and legal services and make law firms a lot more efficient and a lot more modern in the way they do things. So that's a little bit about me. And Scott, maybe if you want to introduce yourself.
Yeah, hi everyone. Thanks very much for coming, and thanks Alex for the introduction. So my name is Scott Weddle. I'm the head of commercial operations here at Swoop Funding. Swoop, which I'll go on and talk about in a little bit more detail, is an online platform for SMEs to basically find the right funding solutions for them at any time. Really just helping people save money anywhere we can. A bit of personal background for myself. As you can tell, I'm not originally from Australia. I'm originally from Glasgow, where I spent 13 years with HSBC, doing a range of different roles, but predominantly in the sort of small business lending space. So really passionate about helping SMEs grow and develop and yeah, helping businesses succeed. Moved to Australia, done some compliance work, and then the opportunity came up to join Swoop, who are a fintech, you know, really passionate about, as I mentioned, growing businesses, which I am as well. So I thought it'd be a perfect fit. So yeah, so I'll just kind of kick off and I suppose give you a little bit of background on who Swoop are and what we do. So Swoop is an online platform where small and medium enterprise businesses can sign up. They input some information about their businesses, specific data points, and what it does in the back end, it matches them to specific funding for their need. So whether that be in the form of loans, so debt, equities, so if you're looking for investment, or grants as well, so government grants are available in Australia. And where we're finding we're really adding value to clients is after they sign up to the platform, you speak to a human just like myself, and we give you that overall business advice on basically how we feel your business can improve, what funding solutions are going to be available to you to help you do that. So that's a bit about who we are. So different types of funding options that we do. So in the form of loans, so we look at all types of loans and we fund with over 70 lenders. So anyone from the major banks to non-major banks to other lenders who sort of think outside the box and are more specialists in different fields. We fund on asset finance, invoice finance, trade finance, working capital solutions. And we use a range of different instruments to do that, really just to help your business perform, grow or start up in the right way. We also deal in equities as well. So we work closely with family offices, venture capitalists. We also work with crowdfunders as well. And then on the grant side, we look at local government grants, state grants, and other types of grants that are just available at any given time, given the business climate or situation. And as I said, all of this is really just geared up, really just to help businesses and give them the sort of best chance to succeed. We find that sometimes the market can be a bit clouded, it can be a bit polluted, and it can sometimes be difficult to find the sort of funding you need or know where to go. So that's where we really sort of bring in our expertise just to kind of help you and manage you through that process end to end. Working really closely with Sprintler on obviously this webinar in particular, and moving forward, we can really see us adding value to each other's clients.
Awesome. Yeah. Thanks for that, Scott. So maybe we can just kick off with a couple of questions about the fundraising process. So the first question I had is maybe if you could just give us a little bit of an overview of the current business landscape and what's happening right now.
Yeah, of course, Alex. Well, of course, it's no secret, there's been a lot happening over the last couple of years. I think COVID's probably been the biggest testament to that. So the business landscape's changed, some confidence has went from the market. Just to reassure, banks are still willing to lend money. People are still willing to lend money. But of course, it's treating it with caution. It's understanding your trade cycles. It's understanding your business growth objectives and really making sure that you're borrowing and growing in the right way at the right times to give yourself the best chance of success. I think if you can be successful in this climate, then you'll live a long life of success as a business.
Absolutely. And so just for some of the businesses that are attending here, at what stage of their journey do you think they should be thinking about applying for funding?
Of course, yeah. Well, listen, it depends on individual circumstances. There's funding options available at any stage. Obviously, from a startup position, depending on how much your startup costs are, maybe you need a little bit of funding for that. There's short-term options, long-term options, depending on your circumstances, whether that be, your history, background, what type of asset position you're in. Another key stage of funding is growth. So if you're in a position where you're confident your business is going to grow, how do you fund that? So what does that look like in terms of hiring new staff, marketing costs, is there office expansion required? All of these different things need to be taken into consideration. And I suppose a lot of it comes down to working capital cycles and understanding at what stage of your business you're potentially going to run out of money from the growth plans that you have. And we can help you do that. We can do sessions on it, understanding that whole cycle, understanding and knowing what stage of the business you are going to need funding, and just making sure that you get the funding that you need to continue the growth. I suppose another quick one as well would be consolidation. So some businesses have maybe previously borrowed in the past. There's a lot of work going on with consolidation at the moment, given the current effects of COVID. We'll talk about it again because it's pretty important. The government are offering at the moment these government-backed SME loans, where they're basically helping businesses recover. So if you're in a situation where you potentially borrowed for growth pre-pandemic, and you're in a position now where you want to sort of consolidate that so you can get ready to potentially grow again in the future, then the government's doing a lot to help with that. So they're backing loans by up to 50%. It's making lenders more available to lend money, and everyone's involved in it. The top 4 banks are involved in it. There's non-bank lenders involved on it as well. So it's a really great initiative and a really great scheme for consolidation at this present moment.
All makes sense. And so what sort of activities can you use funding for? Things like, I guess, marketing, physical assets and equipment, or what do you see businesses actually using the money that they're getting financing for?
Yeah, well, consolidation is obviously a big one, which we touched on. Business growth is massive. So whether that be in the form of equipment, machinery, asset, whether they want to hire new staff, whether it's marketing, whether they are potentially board or renting, they feel they're in a good place to have that asset and purchase the commercial property. That's another, key reason why people are borrowing funds. And, startup businesses is a big one as well. How do you know when you get to that phase where, okay, I no longer want to class myself as a startup because I'm starting to earn money now, I'm standing on my own 2 feet, I'm maybe paying myself a wage for the first time in 6 months. So how do I build on that? So a lot of it is that sort of scale up phase, which there's loads of different financial instruments for that can help you do that. But yeah.
Yeah, so you've touched on this a bit, but just keen to hear a little bit more about the different funding types that make sense for the different sorts of businesses. I mean, one thing we see with our clients is making decisions between, particularly for startups, whether they're going to be raising equity finance and selling some share of the business, or going down the route of debt. And how would you encourage businesses to think about which option they want to choose, or which path to go down? Yeah.
Yeah, well, for me, it's all about your long-term objectives. So you have your sort of short, maybe within the next year, medium within the next, 2 or 3 years, and then long-term 5 years as your plan to potentially grow the business out with the means of debt, which we can help you analyze whether that is going to be the case, at which point you potentially then think to yourself, right, well, maybe I need another investor in here. Maybe I'm moving the business in a direction that's not my expertise. So maybe I need that specialist in there to sort of help me do that, at which point equity becomes a kind of 4 point. If you are looking to, hold on to your business, it's your baby, right? So whether you want to hold on to it for the long haul, you want to grow your business in a sustainable way that can be funded by debt, then there's loads of different instruments and options to do that. And it's a really key, I suppose, education part and understanding that it's not just like, term loans that are out there where you take a lump of cash and you pay it off over 10 years. That's, traditional. There's loads of different instruments now. So you've got things like invoice financing for working capital. You've got lines of credit. You've got asset finance and refinance. You've got business consolidation. There's loads of different options available to you. There's for anyone who's in e-commerce, there's e-commerce financing as well. So there's loads of different niches. So I would always just advise, to reach out to an expert who can sort of advise you on what the best products are for yourself, your individual business, and what your long-term business objectives are.
Makes sense. I think another thing, particularly for small businesses or more startup sized clients, it's been difficult in Australia, at least, to access from the traditional lenders like the bigger banks any kind of debt finance at all, which is why traditionally there's been a lot of equity used by smaller businesses, or when the small companies are able to get the kind of debt financing that they need, it often comes with a lot of personal guarantees or having to put up their personal property as collateral. Is the kind of funding that you guys are sort of facilitating through your platform seeing a bit of a shift in that? Is there more sort of ways for smaller businesses to access finance outside of the traditional bank lenders?
Yeah, well, I mean, there's a lot of unique lenders popping up. So you talk at traditional big city lenders, there's probably about 20, 25. There's over 70 lenders on our panel. So, there's a big market there for these lenders that sort of niche in. In terms of like what's actually available, it's, for startups, it is notoriously difficult. I think everyone recognizes that. I think all we are trying to say is that, if there is a way that you can get funded in the right way. So we want to make sure that you're getting funded in the right way. We don't want you to get the funding, but on the other side, have to pay an arm and a leg for it, and it costs too much. It's making sure you're getting funded in the right way. If there is a way to find that funding for you, then we'll find it. We'll be able to point you in the right direction and help you through that journey and process.
Makes sense. We've just had a question come through from Julie, which might be a difficult one to answer, but she's asked, I'm an Australian, but my company is in China. Am I able to access any of the government grants? Any idea on that one, Scott? Or yeah,
I can take it offline for you. It'd be really good. Yeah, if you can maybe drop your contact details in there, I can certainly reach out to you, and it depends on individual circumstances, so it's difficult to say, but if we can have a conversation about it, and yeah, we can research that for you.
Yeah, for sure. All really helpful. And maybe you can just talk a little bit more about the sweep process. And I should say, so, Sprint Law went through the sweep process ourselves, which I found really, really helpful when we were seeking some of our financing. But maybe you could talk people through a bit about kind of what happens and what the process would be if they decide to sort of work with you guys to access
Yes.
funding. Yeah.
So initially you would go onto the SWIP website, so www.swipfunding.com.au, which will be sent out to you as well. Really simple, you just sign up to the platform, input some basic information, your first name, last name, ABN number, and your email address. You then log on to the sort of platform. What that platform looks like is basically asking you a series of questions, 10 to 15 questions about your individual circumstances of the business. So whether that be average monthly turnover, how long you've been in business for, what type of funding you're looking for, why you're looking for it, and then any other sort of additional information, type of level of funding that you're needing as well. And from there, what will happen is algorithms sort of work in the background, and we match you to specific funders. So we'll basically say to you, off the back of what you've told us, these are the potential funding options that are available to you. Now, where we really stand out is that value added service. So after you've signed up, you'll receive a phone call within the first half an hour, and it will be someone actually giving you a call, discussing with you in a little bit more detail. It's not all just machine driven. We want to make sure that we really, really understand and get to know your business. And then from there, what we'll be able to do is we'll be able to go away, potentially ask for further support and that information that we need, and find a funding solution for you. If there isn't a funding solution available to you, we tell you there and then. If there is a funding solution available to you, we bring them back to you, let you have a look at them, decide for yourself if it's something you want to look at. If it is, then we help you from that process, from start to finish, to obtain that funding, and give you that really good personalised sort of customer service all the way through it.
All makes sense. We've got one question that's also come through from Beck. Scott, you mentioned earlier government-backed SME loans for those with an existing loan. Does that need to be a loan taken out pre-pandemic, or can it be for a loan undertaken more recently?
No, listen, it can be for a loan undertaken more recently, because we're still, so basically the SME recovery loan scheme was due to end on the 31st of December, but they've actually extended it to June. Anyone that thinks we're not still potentially feeling the after effects of the pandemic it'd be tough to say. So any recent funding that's been taken out, it definitely can. All they need to know is that your business has been impacted by COVID, and that can be in any way, whether that be loss of staff, whether it be loss of revenue, whether there's loads of different options there. But no, definitely any loan that's been taken anywhere through the pandemic, it can fall under that scheme as well.
Fantastic. Okay, maybe we'll just switch over to the legal half of things. So I might just give a quick rundown about Sprint Law. So, sorry, let me just try and share this properly. Can see that? Awesome. So as I mentioned earlier, Sprint Law, we're an online law firm made for small businesses and startups. So we offer a full range of legal services covering basically all the different areas of legals that a small business or a startup might need. There's kind of two parts to our offering. We have our fixed fee services. So if there's a piece of legal work you need help with, whether it's getting a business set up, getting a contract drafted, getting a trademark registered, data and privacy advice, employment law, whatever the area of law, we can generally provide a fixed fee quote for that type of service, and then we'll sort of provide it to you. We also have an optional subscription service, which a lot of our clients sign up to if they want a sort of ongoing relationship with us, and that gives you access to unlimited quick calls with our lawyers. Anytime you have a quick question, you can just pick up the phone and chat to someone. If you need a more substantive piece of work, you get a discounted rate on our fixed fee services, and we also have a few other bots and tools that you can use to sort of generate your own legal documents and send things out for e-signature. So we've been around for about 5 years. We're one of the fastest growing, if not the fastest growing Australian legal business at the moment. We've got a bit over 3,000 clients, 45 staff. We're now in 2 countries, recently launched in the UK in mid-2020. And I've got here a little bit of a snapshot of some of the types of lawyers that are in our team. And you can see that we've got lawyers covering different areas IP, leasing, corporate law, technology, regulatory compliance, and so on. So yeah, very happy to help anyone out with any kind of legal needs that they may have, and particularly related to financing and capital raising. We've ourselves, as a fast-growing business, been through the funding process. I mentioned that we did some of it with Swoop, and have also raised a couple of rounds of venture investment through both equity, venture debt, and also just standard loans. So we've been through that. We kind of know what it's like as a business, and that really helps inform the way that we advise our clients. I think lawyers can be too legal at times in the way that they give advice and not really think about the business. But if you're a smaller company, you want someone that understands what financing requirements you actually need and what are the most important terms in the documents when you're negotiating them. And having been through that ourselves, I think we're really quite good at that. So yeah, maybe Scott, we can swap it around if you want to ask me a few legal questions.
Yeah, definitely. Yeah, so thanks again for the presentation, Alex. So some of the questions I suppose we have is like, what kind of company structure should a business have in place before seeking funding?
For sure. So the answer to that sort of depends on what type of funding that you're taking. For businesses that are looking to raise equity investment, venture capital, or through angel investors or seed investors, very common company structure is to have at least a dual company structure for your business. And so this is what we have at Sprint Law. We have Sprint Law Holdings Pty Ltd and Sprint Law Pty Ltd, which is our operations company. The way that the dual company structure works is that you have a holding company which owns 100% of the shares in your subsidiary, the operations company. The operations company is the one that goes out. It does business, it signs contracts, it employs staff, enters into leases, and so on. It's the one that's generating all sorts of liability. And then you have your holding company, in which you can keep your most important core assets, a substantial amount of your cash potentially, any property that you hold, or if you're a technology business, you can hold your IP and software in that entity. What that means is if something goes wrong in the course of running your business, your customers will have legal claims against your operations company, but your core assets are protected because they're sitting in that separate entity. So it's a different kind of company. And so that split is just good to do from a legal and risk perspective for any kind of business. But before you're going into funding conversations, it's a structure that investors will often require or want to protect their investment. That if they're investing in your IP or investing in some core assets, they don't want it to be at risk. And so if you've got a single company structure, everything's mixed together and there's a little bit of risk there. So thinking about that dual company restructure is definitely worth doing. Matters more for the equity investment than the debt investment, but still a good idea to do it anyway. Another aspect of the company structure business might want to think about is just how they hold their shares in the business. In that dual company structure, you could potentially have the business owners being direct owners of that company, but often business owners will set up trust entities which will actually hold their shares in the company. There's a number of advantages to this. There are certain sort of tax advantages to doing it that way, but also it provides asset protection and also protection against liability to other shareholders. If there's a dispute between two business owners, there can be some protection by the fact that trusts are being used. So again, before you're entering into arrangements where you're going to be putting a whole lot of money into the business, you're going to want to be thinking about having a structure that's really thinking about how you can apportion risk and protect yourself if things go wrong. It's true that in a lot of the debt deals that you'll do, you can have your fancy company structures, but the lenders will still ask for either some form of security sometimes or personal guarantees from directors. But certainly having this structure in place can still make a difference in sort of protecting against risk.
Thanks, Alex. And what are the kind of key legal documents for startups and SMEs raising equity investment, and how does that process work?
Yeah, so the equity investment process is kind of unique. It's when startups or small businesses are capital raising, typically what they'll need to do is work out a valuation for the business. What do we think the business is worth now? And then work out, okay, well, we're going to raise a certain amount of investment, and that investment will entitle the investors to a certain percentage of the company. And in doing so, you need to work out, well, what's 100% worth? So what's the value of the overall business? And then how much are we going to be selling in a sense that 10%, 5%, whatever it is for how much will that cost the investors. So typically what businesses will do, will come up with a valuation. They'll also have a little bit of a think about what rights are these investors who are coming into the business going to have. Unlike a debt situation where you have a lender that's lending money you have to repay, in an equity scenario, the investors actually will own a portion of the business. They'll have a little slice of the pie. And so in addition to thinking about what they get for their investment, they also will have rights to potentially vote on decisions of the company and have some control over the direction or management of the business. So it's also worth thinking about, what are those rights going to be? How are they going to work? Typically what happens is you start off with a term sheet, a simple 2-page, not really binding legal document that sets out the key terms of the deal. We're going to be raising $1 million for 10% of the business, and the investors will have XYZ rights. Discussions are then had with a bunch of different investors. The terms may be negotiated a little bit, and then the term sheets are signed. And then it's at that point usually handed over to the lawyers in a bit more detail to prepare a couple of agreements. One is called a subscription agreement, which is a longer form document whereby it's kind of the investment agreement. Money is put in exchange for the percentage of the business. And then the second document is a shareholders agreement, which businesses should consider having anyway, whether or not they're raising investment. But the shareholders agreement is an agreement between all of the different shareholders of the business, talking about the management and running of the business. And again, if you're giving your investors some management or control rights, the details of how that works set out in that shareholders agreement. So really, it's kind of a 3-document process. There can be others depending on a specific situation, but you start off with a term sheet, and that kind of manifests into these 2 longer form subscription agreement and shareholders agreement documents.
Brilliant, thanks for that. Questions come in there on that as well. So does the dual structure increase the setup cost?
It does. It certainly does. One set up one company costs somewhere between $500 and $1,000, depending on how much you do yourself. And then you've got annual renewal fees of something like $270, and then there's maintenance for the businesses, tax returns, and so on. If you have 2 companies, you kind of double that. Usually if you're working with an accounting firm that's taking care of your renewals and tax returns, they'll do a bundle deal because dual company structures are generally very similar and not twice as much work as one company, but it does double the setup cost. And so it's a lot of smaller businesses don't bother doing it in the early stages. If you do have plans to really grow the business and raise financing, though, it's kind of a small cost to pay for the eventual benefits that you get from the split of the structure. And also investors, particularly equity investors, typically require that structure to happen anyway, at least at the bigger funding rounds. So there can be sort of tax consequences and tax costs if you leave it too late in your business journey to actually do the restructure. So yes, there's definitely setup costs, but depending on the business's goals, it's something to definitely think about, and it can often be worth it. Yeah.
Brilliant. Thanks, Alex. Really informative. What about debt and loan financing? So what's the sort of key legal documents, things to be aware of there when you're actually taking out debt?
Yeah, so the debt and loan financing stuff is a little bit simpler. You don't need to go through the process necessarily of having the term sheet and negotiating with multiple investors and then ending up with these 2 long form documents where you think about management and control. Typically, the debt loan financing is just managed just through contracts. So there'll be a contract between the lender and the business. And in some circumstances, the lender will want either security over some assets of the business or want some sort of guarantee, personal guarantee from the directors of the business, just to make sure that if the business is unable to repay the loan terms, they have some form of protection. So that's not required in all cases. Some lenders will provide unsecured debt where it's really just provided to the business with very little security. And that can be attractive for business owners that are a bit risk averse and don't want to take up the risk of having personal liability if things go wrong. But typically you're able to get higher loan amounts and potentially lower interest rates if you're willing to provide some form of security or guarantee. And again, I'm sure you're sort of aware of all that stuff, Scott, with the different lenders you work with at Swoop. In terms of the legal documentation, depends on who you're working with. Typically, lenders will have a standard loan agreement or standard form of agreement, depending on what kind of debt that they're providing, a line of credit agreement, if it's a line of credit or a term loan or whatever it is. So there's a legal document there which sets out what the rates are what happens if you're unable to repay, if there are penalties for late repayments, if there's penalties for early repayments, and all those sort of fun sorts of terms. Often with institutional lenders, so businesses that lend to lots of smaller businesses, there's not that much you can negotiate other than potentially the interest rate, and even sometimes that's not hard to negotiate. So it's often from a legal perspective, closer towards a take it or leave it deal. But there is often, particularly with venture debt lenders, a little bit of room to maneuver and wiggle in terms of the terms and sort of get a better deal and reduce your risk from a legal perspective. So it is a good idea to get lawyers, even if you're signing a sort of out of the box loan agreement, always a good idea to get lawyers to look over it for you, let you know what you're signing up for. Often with loan deals, there's a whole bunch of hidden terms, hidden interest rates, hidden penalties, hidden fees. Despite what the lenders may advertise, it's just part of their business model to protect themselves against risks. So it's worth understanding exactly what those are before you sort of sign at the dotted line and what will happen when things go wrong. So yeah, it's basically just loan agreements and potentially those other documents.
Yeah, and I'd agree with that as well. No one lender's sort of the same, they all have different sort of caveats and conditions to their loan. So it's always really good to be well aware of what you're signing, which is, brilliant where Sprintlaw come in. And I've got another question come in here. So does Sprintlaw take care of the accounting side of a client company?
We don't take care of the accounting side. We do have a bunch of really good accounting partners, and I think Swoop, you guys do as well. And I think they're some of the same ones because they're good partners. So if you are looking for an accountant, do sort of let either of us know, and we should be able to introduce you to a few that are really good with small businesses and startups. I think we do work closely with accountants, particularly when it comes to A, business setup, and B, sort of capital raising, because the tax side and the law side get very intermingled. But yeah, we're really a legal business.
Yeah, okay. Another question here from Carol Snook. So Carol's asked, if we have a discretionary trust with several entities operating under that trust, what are the advantages of registering a PTY limited entity?
Probably need a little bit more info to provide specific advice on that particular scenario. If you're operating out of a trust structure, so your trust is the thing that signs contracts and enters into contracts with businesses. So you have just a trust and you don't have a trust and a company, which I think is kind of what you're alluding to in the question. It's cheaper to manage than having the trust and company thing I mentioned earlier. So that's the advantage of doing it that way. Where it gets difficult is you can end up in a complicated scenario. If you want to sell your business or take investment in your business, it's very difficult to take investment in a trust because oftentimes the trust is intermingled with the business affairs and potentially your personal affairs. And if you want to separate the business from the personal, it can get complex. It's also less common to take investment directly into a trust. It's more common to take it into a company structure. So a lot of our clients will start off just operating out of a trust structure. And then when time comes to either sell the business or raise funding, they'll restructure a little bit to make the trust the owner of their actual separate standalone company. And then that company is easier to do things with. The ownership of that can be split to, unrelated parties. Investment can go into that company without messing up your sort of trust that you're using to manage your own kind of personal affairs. So worth speaking always to an accountant and lawyers about the restructure involving trust, because it can blend into sort of what you do in your personal tax affairs. But yeah, there are definitely advantages to having both the trust and company together rather than just a trust.
Great, thanks for Alex. What about convertible, say financing? What's the sort of key legal requirements there?
Convertible financing is becoming an increasingly popular way for businesses to raise investment. We're seeing it sort of more and more, particularly for startups. I mentioned before a little bit of the complexity around an equity raise. You put a value on the business, you have to put together a term sheet, a shareholders agreement, a subscription agreement. It could be a little bit involved, and particularly for early stage companies that are growing fast, it can be difficult to work out what the company's worth. Maybe you haven't generated revenue yet. Maybe you haven't proven the business idea. So what value are you going to slap on it, and what percentage will you give away for investment? So convertible has a number of advantages, but it helps avoid that question or put off that question to a little bit later. Typically, what you do in a convertible finance is, rather than putting a value on the business, you'll say to investors, look, you give me X dollars, let's say it's $100,000 or $200,000, and I will give you a 20% discount on the price per share, or some discount rate on the price per share of the equity that we issue at our future round that will happen one day into the future. So you can almost think of it as like pre-sale tickets to the equity show, if that makes sense. There's a discount that's being provided, an early bird discount being provided by taking an earlier risk. It can be beneficial for the company to do it this way because they may not know what they're worth. They may, if they do an equity round too early, be giving up too much before the business is proven. And if you can grow the business in value by higher than the discount rate that you're providing to the convertible investors, you actually are going to end up in a better position than if you take the equity financing at the beginning. So the convertible, there's a few more complexities to it. Some convertible instruments have an interest rate if you take too long to actually do that equity round that you promised. And they sometimes have something called a valuation cap, which means that if the valuation of the business sort of explodes and becomes worth much, much higher, the investor gets some cap and some benefit so that they really get the value of when they invested earlier. So the most common form of convertible instrument we see these days is a safe note, which is a very, very simple document. And the advantage of these things, and particularly the safe note, sort of high level, is that they are very, very simple documents. You don't have to go through a complicated process of raising equity, and you can just sort of get them signed and get the money in your account relatively quickly. So very, very common with startups these days to use some convertible or safe financing instruments prior to raising an equity round.
Thanks for that, Alex. Is there anything else that business should be aware of prior to raising funding? Maybe things like protecting intellectual property, or?
I think we've covered most of the important points. I think it's just, to reiterate, important to make sure that your legal documentation is checked before you sign anything. These documents are not really like your standard website terms and conditions you might download off the internet. They're very, very important documents with which carry significant implications for the business, significant risk, and so on. So important to understand what they are and sort of get them done right. I think you generally want to use raising funding as an opportunity to do some housekeeping and cleaning up of your business. If it was just you before and you're switching from it just being your business to now having other people being invested in its performance, having your legals in order is a good thing to do because it can help reduce risk if things go wrong with the investment. So things like registering your trademarks, protecting your intellectual property, making sure everything important to the business is owned by the business and there's not going to be some existential risk that comes along, throws everything sideways and makes it difficult for you to meet the promises you made at the time of financing. I think that's probably just more of a general good risk management thing for people to do, a bit of housekeeping before they actually take the money out.
Great. And any other ways that Sprintlaw can help businesses with their legal needs during the sort of fundraising itself?
Yeah, maybe just to sort of emphasize, we provide a whole bunch of financing related legal services. If it's a loan that you're about to take out, we can provide a sort of fixed fee loan review. If you are taking out equity financing or just even want some advice on how to approach the capital raising process, we can provide consultations, fixed fee, or fixed fee versions of those shareholders agreements and subscription agreements that I mentioned. One good thing about us is because we've done it ourselves and helped so many businesses go through this process before, we really know what's normal. We've seen everything before, and we can bring that knowledge to bear in advising you on, what you should and shouldn't be sort of agreeing to. And I think we're finding that's really helping our clients. And a great aspect of our business model is that we have so many clients, and so we get to really see what's normal in the market and not, and all of our clients benefit from that.
Great. Just one final question that's come in here, Alex. So we've got a law student who is in their final year and have an app with a potential revenue of at least $2 billion in 12 years. She is looking to network with yourself and sort of speak with Sprintlaw just to take care of the legal stuff. So some good feedback coming in for yourself, Alex, as well. And if you could sort of connect with Rowan, that would be awesome.
That would be awesome. And $2 billion sounds like a big number. So if you could achieve that and we can help you in any small way, of course, would love to.
Great. There was one more question here about how important is doing all the homework prior to raising equity. So, for example, business plans, budgets, feasibility. speaking personally from dealing with equity deals, I can say it's very, very important. Even how your business plan looks prosthetically can be very important. Make it look attractive. You know, have the budgets in there, have the correct forecasts, realistic forecasts as well, can make a big difference when looking for equity funding.
Yeah, and just to add to that, I think you know, the process I've found, having raised a few rounds of funding, the process of actually doing the business planning and the forecasting is not only useful for you know, working out the pitch to your investors, but actually internally very, very useful to work out exactly how much funding that you really need. You don't want to be taking more money than you need, but working out how much money you need requires a little bit of planning, a little bit of thinking a bit more about the business. And with the business planning stuff, I think you can certainly go overboard and prepare 300-page business plans that no one will ever read. And we definitely see people waste a lot of time on the business plan stuff, but it's definitely worth doing some business planning. The way that we've done it is we've worked on a really articulated deck that we spend a lot of time on. It's not just a few bullet points on some slides, but we spend time really articulating the message as to what we're trying to do and what we're going to be doing with the funding, and putting that together, you know, helps me as a founder actually pitch it to investors, because I made the deck and I've been thinking about it for so long. I really know how to communicate the message. In terms of longer form business plans, we have some internal documents with kind of done in an FAQ style, and we find them useful when investors ask us questions about the business. What are your long-term plans? What are you going to do with the funds? We get the same questions a lot, so we just copy and paste from the kind of internal business plan doc into their email responses, and that just makes things a little bit more efficient. So I think you can get by without a really long form business plan, but it depends on the business and how you run it, and some people may find that useful. Awesome. Okay, I'll just have a quick skim and see if there's any other questions that we might have missed. I think Lisa made a good point that if you're looking at getting R&D, you'll need to have a company, not a trust, which is, yeah, definitely a good point to make. And also looks like Lisa's asked a question for you, Scott. Do you guys charge upfront fees or commissions via the loans?
Generally, no. Occasionally we may add a small sort of consultation fee, but in general, no, we don't. And the commission, we get paid from the lender always, or we get paid from the writer, so we never actually charge the client.
All sounds good. And Craig, sorry, Craig, I missed this question from a little while ago, but how do dual company structures work within a family trust? I touched on that a little bit earlier, but what you would typically have, and again, I can talk a little bit about the structure of Sprint Law because we have something a bit like this. You've got your operating company, which is wholly owned by your holding company, both PTY Ltd companies, and then your holding company would be owned typically by family trusts by the different shareholders. So, you know, in Sprint Law, for example, at least at founding, we had 2 founders who had family trusts, each owning a percentage of our holding company. The holding company owned 100% of the subsidiary, and that's a common way to sort of set out your structure, where you benefit from the trust structure, but also the dual company structure. Awesome. I think we've just about run out of time, but thank you all so much for attending. As we said earlier, we'll be circulating some of the recording of this webinar if you want to revisit any aspects of it. And also, I think our details if you want to contact Swoop or Sprint Law for any legal or funding requirements. But yeah, it's been fun to chat, Scott. And yeah, anything else you wanted to add?
No, thanks everyone for coming. Always great to talk about the different funding and financing options that are out there, and great to work with yourself as well, Alex.
Awesome, amazing. Well, we'll see you all later.
Bye.